Mobile homes might just be the most disrespected asset class in all of American real estate. And that disrespect might be making a small group of investors quietly, absurdly wealthy. We're talking about an investment that gets laughed out of dinner parties, but is currently outperforming multifamily in several markets across the country. The catalyst here is deceptively simple. Housing affordability has collapsed so completely that millions of Americans have been priced out of traditional homeownership, and manufactured housing is one of the last legal, scalable ways to house people at a cost that doesn't require a small miracle. When the median home price crosses $400,000 and wages haven't kept pace since the 1980s, something has to give. And that something is the stigma around mobile homes. Think of it like this. The housing market is a crowded restaurant where everyone is fighting over tables in the dining room, and manufactured housing is the patio out back that seats just as many people, but nobody's thought to look. The macroeconomic pressure of rising rents, stagnant wages, and disappearing starter homes is essentially funneling demand straight into this overlooked corner of the market. Just a few years ago, you could find breathless think pieces about build-to-rent communities and short-term rental arbitrage dominating every real estate podcast and YouTube channel. The enthusiasm for those strategies has cooled considerably as interest rates climbed and margins got squeezed, while manufactured housing sat there, boring and unbothered, continuing to generate cash flow. The psychological weight of investing in something society looks down on is genuinely underestimated. And plenty of capable investors have walked away from solid deals simply because they couldn't get past the aesthetic. But Warren Buffett didn't buy Clayton Homes, the largest manufactured housing company in the United States, because he was chasing prestige. He bought it because the numbers told a story that pride couldn't argue with. History has a pattern here that's worth studying closely. Every time conventional housing becomes unaffordable, alternative, and workforce housing surges in demand, and the investors who are already positioned collect the reward while everyone else scrambles to catch up. We saw echoes of this after the savings and loan crisis, after 2008, and we're watching it unfold again right now in slow motion. Here's where people get it wrong. They conflate the depreciating asset of a single mobile home sitting on rented land with the entirely different investment thesis of owning the land itself or buying an entire mobile home park where you collect lot rents. One is a car, the other is a toll road, and confusing the two is the single biggest misconception that keeps intelligent people out of this space. The fear that manufactured housing is somehow too risky or too niche falls apart when you look at occupancy rates in mobile home parks, which have historically hovered around 95% even during recessions, because the residents simply have nowhere else affordable to go. Resilience isn't a selling point you'd expect from something with the word mobile in the name, but here we are. The practical lesson from investors who've navigated this space successfully is that deal discipline matters far more than market timing, buying right, knowing your lot counts, understanding your infrastructure costs, and never overpaying, because the story sounds exciting. Moderate leverage, conservative underwriting, and a genuine understanding of your tenant base will carry you further than any conviction about where the market is headed. Position sizing is everything here too, because this is not a space where you want to bet the farm on your first park acquisition without deeply understanding local ordinances, zoning restrictions, and the hidden costs of aging infrastructure like water and sewer system. The investors who've gotten hurt in manufactured housing almost universally got hurt by moving too fast and too big before they understood what they were actually buying. There's a beautiful irony in the fact that an asset class associated with lower income has quietly become a high-demand institutional play, with private equity firms and REITs aggressively acquiring parks at a pace that is genuinely alarming to longtime independent operators. Sun Communities and Equity Lifestyle Properties are two publicly traded companies doing billions in revenue from an asset class your uncle jokes about at Thanksgiving. The philosophical truth at the center of this whole conversation is that returns don't care about your feelings, your aesthetics, or your social comfort. And the investors who internalize that earliest tend to find opportunities in the places where everyone else's discomfort creates a discount. Discipline, consistent process, and right-sized positions in assets with genuine demand will outlast any hot trend chasing the approval of the crowd. If this asset class doesn't end up being the right fit for your portfolio, that's a completely rational outcome, but at least let that decision come from analysis and not from embarrassment, because the spreadsheet has no idea what the neighbors think. Comfort with any outcome starts with honest preparation. And honest preparation starts with actually running the numbers instead of dismissing the category before you've looked. Whether you're ready to explore your first mobile home park, curious about workforce housing as part of a broader portfolio, or simply want to understand what returns are actually possible here, the research and the hustle have to come before the reward. Check out our links in the description below. We can help you get started, whether that's real estate investing, home contracting work, or connecting you with lenders who understand this space.